Hi friends, you want to know the difference between a VA loan and a conventional loan? This is the video for you. We're going to analyze the difference between a VA loan and a conventional loan, the pros and cons. VA is awesome because it's 100% financing, and we're talking about federal VA. Conventional, we're going to be looking at a 5% down conventional loan today. So the difference, purchase price is $450,000 VA. Your loan amount is going to be $460,350. The reason being is that you're going to have a VA funding fee. Let me talk about that VA funding fee for a quick minute. Now, the first time that you used your VA is going to charge you 2.3% of a funding fee, and that's financed on top of your loan amount. Any subsequent use past that first time, your cost will be 3.6%. This is in 2022. If you put 5% down, your VA one-time use drops from 2.3% to 1.65%, and a subsequent use is 1.65%. If you put 10% down, it drops to 1.4%. And again, subsequent use 1.4%. Anytime that you use your VA, at least if you're going 100% financing, that funding fee is going to be 2.3% or 3.6%. I'm doing that based upon you've never used your VA in the past. Current interest rate as of today is roughly 5.25%. This was for a credit score of 760 or higher. APR is roughly 5.454%. I'll break that down a little bit more in the TCA. Total payment, because there's no mortgage insurance or anything, is $2,542. Now, I will state that conventional is a $46 savings over VA. However, VA, you have zero into the transaction at this point. I'm not going to discuss closing costs today. That would be the one thing that you'd have to pay. At this point, you have zero. You have no down payment and nothing else in the transaction. Now let me go to conventional. Conventional is $450,000. You're 5% down. Your loan amount is $427,500. Again, the interest rate is 5.25%. I will state that that is with a 1% discount fee, where VA did not have that 1% discount fee. Your APR is 5.847%. Total payment is $2,496 per month. I'll break that down because you do have mortgage insurance on a conventional loan. Cash to close without closing costs, $26,775. Now let me walk through the payment here. The payment you're looking at, mortgage insurance is roughly $135 a month. That would be, again, a 760 or higher credit score, 5% down. If you go to a 3% down, that mortgage insurance is going to be more expensive. If you have a little bit higher credit score, that mortgage insurance is going to be a little less per month. If you have a lower credit score, the mortgage insurance is going to be higher. So mortgage insurance is going to be based upon what your credit score is. So again, you're really looking at the difference between the two of $46 a month. For me, $46, if I don't have to come up with $26,000 to close, I would go VA 100% of the time, because I could take that. Even if I had the $26,000, I would take that $26,000 and then reinvest it someplace else, create arbitrage, which is what the banks do. Now, I said that I would go through closing costs. I'm not going through one-on-one closing costs. The only difference between this is VA has a $10,350 funding fee that's financed on top of the loan amount, and then conventional, 5% down. Our points to buy that interest rate down 1% is $4,275, hence $26,775 to close. I hope that this shared the difference between VA and conventional. There are major benefits, I believe, to a VA loan, especially on the federal side, where it's that 100% financing. One thing that we really need to look at is suitability and how long you're going to stay in that house, whether or not a funding fee of $10,000 makes sense or not. If you're going to be in there short term, it may not make sense. We can look at the total cost over time through the total cost analysis that we've done here. I hope that you've liked this. I hope that you found value in this. If you have, please like our YouTube channel. We have a lot of other information there. Just reach out to us. We're here to help in any way that we can. Thanks. Have a great day. Bye-bye.